Hi, I'm Mal from the Mighty Study, bringing you another episode in our Take 10 challenge. We're up to number 20. This one's a little bit different. I'm calling this one Where Are We? And before we kick it off, there's my disclaimer. And it's facts, it's all about figures, it's information. And I'm going to really push the point here with my disclaimer in this particular episode because I am not an economist. I don't know what's going to happen. I don't think anybody knows what is going to happen with the economy. All I'm here to do is to sort of help you to think about where we're at, what's going on, and just a question before you jump in. So anyway, let's just dive into this thing and see if we can come to some sort of conclusion. Okay, here's a picture of what we call the American index. It's the S&P 500. And what this is, it represents the value of the top 500 companies in America. Top 500 companies, and it goes all the way back into the 90s, and we had this really big boom where the prices went rocketing up during the 2000s and 2001 when we had the tech boom, where everybody thought that anything with a .com after it, a company that was anything to do with the internet, was going to make $1 billion. So the market loved it. But then, of course, we had the situation where not every company on the internet was going to make money. They realised that, and down came the market. It then went basically up again into 2007, pretty much the same level it was back there in 2000 or so, and effectively then we had the GFC. And the market fell into 2008 and 9, and we get this bottom where the government started to panic. They were worried that everybody was going to go broke, the banks were going to go broke, and so they stimulated, they bailed out the banks, they threw millions of dollars into the economy, or billions of dollars into the economy. They lowered interest rates to ridiculously low levels and distorted everything to help the market. And boy, oh boy, did it help it. And up she went. And you can see there basically from 2009 up to where we are at the moment. It got up into when Donald Trump came in and the market sort of went up and down like a yo-yo. And then, of course, we had COVID. The market fell in that 1920 and during COVID. But then, governments then reacted to it and just threw money at anybody who had a pulse. And, of course, the money was just handed out to people like in Australia, Harvey Norman and goodness knows who else. And I'm not going to get political, but there was a lot of free money and all at ridiculous low interest rates if you were borrowing money. So people could be borrowing money under 2% and buying shares that were going through the roof and buying property. And all it did was just push these things up and push these things up. Because we get to the end of COVID, and at the peak there, what happened was they stopped all the stimulus at the same time that interest rates started to rise, and therefore the market fell. But of course it didn't fall for long before they realised, well, hang about, everyone's still buying. There's still people buying at the shops, and this just really doesn't seem anyone too much struggling with these interest rates. So up went the market again. And of course now, if you look at where we are right now at the very end of the graph, we're at the highest ever that this American market has ever been. But look where it is. It is sort of and here we are in the middle of a climate where we have wars in Ukraine, wars in, of course, in the Middle East. We've got China doing a bit of saber rattling, and we've got these ridiculously, well, I shouldn't say, the interest rates going up. I don't think they're ridiculous because they're probably where they needed to be. But we're putting pressure on people who haven't seen interest rates at these sort of levels before. And then we've got all this debt. There's so much debt out there. I mean, the GFC back in 2007-8 was caused by there was too much debt and it had to be paid back. We've now got triple the debt in some places, even more in some countries and so forth than we had in 08. And that was caused by debt. And we've still got more of it. And we've got interest rates going up. We've got wars, we've got supply chain problems with obviously ships having to go around around Africa and so forth, in what we would normally call pretty volatile sort of time. I'm recording this as of Sunday the 4th of February. Probably you won't get it for another few more days yet, but 4th of Feb, on the weekend, and over the weekend, America started bombing into Syria and Jordan and other places as well, which you would think would be some sort of an escalation of the war. Is that good? Well, sometimes economies go up because of all the extra spending, but is it actually good for the overall economy? Anyway, I'm not going to sort of dive into it too deeply, but you can see here we're at a pretty strange sort of position. And if you look at the situation, I've just drawn this blue line on here, sort of representing what the market did there from 2009 up to 2020. I just draw a line to sort of represent the market sort of going up at a normal sort of trend, and every time it got a little bit too high, it would come back towards that blue line that I've drawn. And of course, in the last few years, it tried to come back down, but it came nowhere near the line, and then of course it's gone even higher. Now, as I say, things go in cycles, things go up, things go down, but they tend to come back to some sort of normality. They tend to come back to some sort of normality, which you would normally think would be this average sort of trend over this last decade or so. Now, of course, if this thing falls from where it is at the moment down to that blue line, we are talking, sort of 20 to 30% fall for the market, which would be, dare I say, upsetting for a few people. And of course, if you look at that blue line as a trend, that was pretty much like we had in the rise up until 2007, and that was sort of like a boom before the bust in the GFC, pretty much like what we had coming up in the 2000 or so when we had the tech boom and then the tech bust. So what we've got over the last decade or so really is an extended long boom based on ridiculously low interest rates held too low for too long, at the same time that they're handing out free money. That's all stopped. Surely it's got to have some sort of an impact. Now, as I say, I am not an economist. I do not know what's going to happen. This market could absolutely roar from here. We're actually in the middle of what's going on right now. Because the market's been going up so strongly, it's sort of like everybody's buying, so everybody buys, and more people buy, so more people buy. And this thing's just going up is like an elevator. But of course, what happens when, just about everybody's interested is already bought, and then some of the people say, getting a bit high here, perhaps I'll just, sell out and take a bit of a profit. Is this thing likely to go higher from here? Yep, certainly could. Is it more likely to go up than sort of just stable and wait for things to calm down? Is it likely to come back to normal? Yep, at some point. Will it just go sideways for, it may not just fall down to the blue line. It may indeed just sort of, air might just fizzle out of it, and it might take 3 or 4 years to come back down, which means that's negative returns for 3 or 4 years. Might go sideways waiting to catch up to the normality. That's like 10 years of nothing. To get back to this line, now say I've just drawn that line. That doesn't mean it's not. That doesn't mean everything's got to, is based on me drawing a blue line. All I've done is just sort of say that's what's happened over the last decade. Things tend to sort of just trend along. We've now had this absolutely takeoff based on interference by the federal banks and so forth. What impact is all of that as it unwinds? Now, if you draw another line in it, this line down the bottom here, this is what the share market, this is the normal trend of the share market, going back nearly 80, 90, 100 years. And you can see there where the GFC, back in 2008, when the market fell, where did it come down to? Where it really belonged, after the longer term trend. Now, this is all very interesting as to, now I'm not saying for one instant that this market is going to fall from where it is now down to that bottom line. I mean, that'd be like 1929. We'd have people jumping out of buildings. It'd be like an 80% drop. Now, I'm not expecting that. I don't know what I'm expecting. All I'm saying is understand that we are in weird sort of times. Everything's been based on distortion of the market by the reserve banks and the federal banks of the world. And no one seems to be sort of, waving a red flag or saying anything. They're just sort of saying that, yep, things are good. They're talking about now rate cuts because, think that they've got the inflation under control. But doesn't that mean if we're getting a rate cut, they have to stimulate? Doesn't that mean there's something wrong? I don't get it. Anyway, as I say, I'm not an economist. I just find these things fascinating, and the more I look into it, the more I believe that perhaps I'm the only one out there that's just shaking their head. I don't know. Anyway, it's just a case of if some of this sort of makes a little bit of sense and you are a tad worried, just think how your money may be invested and what may occur. The older we are, the more money we've got, then effectively the more risks that we have because we can't replace it. And if more money we've got, 10% drop will cost us more. Obviously, in future sessions, I will be going through investments, portfolios, risk on its management, and so forth. There's a lot to cover in the next 15 years of me doing this. But anyway, just an oddball one today. Just for this is how my brain works. I'm not too sure whether that's a good thing or bad. We'll talk about more things coming up.